A trading log is a diary or a journal of what you've been doing and why you've been doing it. So when you start to find your rhythm with placing lots of trades, you'll start to forget what you did 5, 10, 20 trades ago. And so by keeping a detailed log, we have a good way to look back at what we've done and be instantly reminded. Now I have to say, amateurs tend not to pay much attention to doing this because it can feel quite long-winded to do, and I won't deny that yes, sometimes it can feel a bit like that. But in keeping things like a business, as we should, then this is something that we must do if we want the best chances of doing well. Keeping a log is good for two main reasons. Firstly, over time this will allow us to build up a big picture of our habits, and so every so often we can review all of our trades collectively to see if there are any tweaks we can make to improve performance going forward. And remember that regardless of what success we may or may not have already, we should always be looking to improve even when we're years into doing things. So if we log everything we do, we're essentially giving ourselves that opportunity to look back at our performance. The second reason why a log is so important is because it's going to help us to stick to the strategy. I'm sure you've probably discovered this already, but it's very easy to place some random trades without much thought behind them. But by keeping a log, we're being encouraged to think about those things like position size and the reward to risk ratio. So by having those in there as boxes we need to fill in, we're naturally encouraging ourselves to follow that process that we should be. On page 238, we have the bare minimum criteria of what I'd like to see in a log. For the entry criteria, we have the product, the direction, the date and time of getting in, and then our three prices, the entry, the stop, and the target price. From there, we can calculate the reward to risk ratio, which should be greater than 2, and after that, the percent we want to risk, which is anything up to 2%. And from there, we can work out the position size. So that's it for the entry criteria, and then when we exit the trade, we should log the date and time, the price, and the profit or loss made. Also, what I've mentioned in the pack is that it's a good idea to have a self-reflection on how well you followed your plan. So this is where you can comment on things like whether you followed the plan or not, and here it's important that you're brutally honest with yourself. If you made mistakes or you know you should have done something differently, make sure to keep a note of that, because you aren't trying to impress anybody here. It's only going to be you and possibly me, if you choose to share yours with me, that's actually going to see it. So by being honest with yourself and facing up to any mistakes, you're giving yourself the opportunity to improve next time. And I would actually be a bit concerned if you didn't make any mistakes at first. They're a natural thing to happen when you're first starting, and that's why the demo is so important. Now, as I mentioned, everything I've said here is the minimum of what we should include in a log. But if you wanted to take this further, keeping a log of the top down would also be good, and even better, a screenshot of the chart as well, because that will show you the whole pattern and justification for the trade. Now, how you choose to do your logs is going to be a personal preference, but in the next video I'm going to give you some templates to work from.